everyone to Financial Fox Smart Investing with the stock and market guru Zach Meir and Clem Chambers that is joined very shortly. So Zach, how are you?
Well, I think the whole COVID thing is starting to go completely pear-shaped. It's a complete disaster. I think it's worse. You're too young to remember Dad's Army, but it's a complete comedy show. If you look at all the correct figure to look at is the amount of fatalities, obviously, because that's what it's all about. And they're just the same, even with Omicron and whatever other variant they can make up, Zeta, Gamma, Delta, everything else that they've come up with. So a complete disaster. I think that's good in a way, in the sense that we sort of realize that most of us are still alive, and what a fiasco the whole thing is. But it'll be interesting to see how governments, etc., and manage to get out of this, because they've made a total monkey of themselves, and it is extremely.
They should get another furlough in place. I mean, they should get another furlough in place if they are prohibiting people.
Yeah, no, but the problem with furloughs is that when you put people on furlough, they don't want to come back. So then you get supply chain issues, and then you get inflation, and you get all sorts of idiotic consequences. So that doesn't really work. You probably have, if it is that bad, we should basically have universal income and forget about working and all these sorts of things as well.
Like a communist country, I'm not sure about that. I mean,
well, we're already in a communist country, because we have you're not allowed to say anything, so that's a communist country. So I think we're already there. I'd rather go and live. I'd rather live. No. I think that there has to be a little. No, there should be a bit of the middle-aged rant, just because it does actually set the scene for the financial markets. I think if you look at the markets with that kind of backdrop, then you know, for instance, that when they say they're going to raise interest rates, they're not, because they can't, because they've said we're in a COVID crisis. So you can't raise interest rates in a COVID crisis. You have to take the inflation thing with a pinch of salt, in the sense that was created by supply chain issues. And so if we do go to furlough, then probably supply chain issues will get worse. If we don't, then things will gradually get better. So all these things, I think they do have an impact on the financial markets. Going on to the markets, I think it's been interesting that, I suppose, since the November peak, I was looking for some like happy crypto situations, and I can't really see, there's hardly any happy crypto situations. So it looks as though even that area, the liquidity has dried up. I'm not saying that they're going to go down or stay down, but the liquidity there has gone down. Slightly better in the small cap area, which is my area. So a few more stocks going up 50% in a day than they were before. So that looks a little bit better, but that might be just end of year window dressing. You had the Fed, again, that's what I was saying about interest rates. On Wednesday, yesterday, the stock market, the US market rallied after the Fed, because just talking rubbish about raising rates or tapering or anything else, they can't do that. If they do that, they'll go bust themselves. So they can't do that. So I think it does sort of add up and join up in a way. And I think I'm just trying to justify the middle-aged rant, but I do think that it is relevant. The geopolitical situation is relevant to the financial markets, and understanding that is relevant too. Just had, for instance, France banning British visitors, non-essential British visitors, which means obviously every British visitor, because why would you go to France on an essential mission? There's nothing to do there apart from non-essential stuff. So you have things like that. So it's getting very messy, and it's almost like city season. But I'll hand back to Clem. How are you today, Clem?
I'm fine. Everybody seems to be going down with COVID left, right, centre, everywhere. But
it's called flu.
Thank goodness most people got a vaccine, and therefore they're not going to die of it. So, I mean, that seems to be the key thing. If you're vaccinated, you're not going to die of it. And if you're not vaccinated, you could well do it. Could well pop your clogs.
I think what it is that if you are vaccinated, you're less likely to die of it. But if you're not vaccinated, then you're probably toast.
Oh gosh.
Yeah, well, I was nearly a toast because I got it before the vaccine, and it was the worst. And because I used to live on a plane, I got all the flus going. I've got pneumonia a few times, and it knocks the socks off with pneumonia even. So it's there's people who don't want to get vaccinated. It confuses me because I don't understand.
I mean that is. Yeah, but the problem is that governments have played it so badly that you can understand why there are anti-vaxxers, can't you? I mean, that's the thing. I mean, they have been. It is. You can go to a pub. You can go to a pub, but you can't go to a party, or you can go to a party. You can't go to a pub. You can, meet 2.3 people, but you can't meet 4.6 people. I mean, all these arbitrary, idiotic rules, which they are idiotic rules. I mean, it is an anti-vaxxers charter, isn't it?
I guess I kind of understand where they're coming from, to be honest, because they don't trust they don't trust other people, and when it first came out and they said they're going to get a vaccine, I actually think I said online, well, I'm quite happy to let all the people that really need it go first. And that is understandable, right. But it's also people go, oh, some people can die from this. 1,000 people have died from it. Yeah, apart from 700 million have taken it, but that they see the 1 in a million rather than the 1 in 200 that they might be if they get it.
So the question is now, are we going to go back into the full pandemic financial system mode that we had, sort of early last year, or is it going to be just a mess? As we're currently in a mess, really, aren't we? We're neither here nor there.
I think it's going to be a mess because I think even the innumerate politicians realise that if they go through another year or so, or even one more time through all this lockdown and disruption, then they're all going to go, well, more than bust. I mean, we've all gone bust. All the countries have gone bust. And they're kind of all gone bust together, which is kind of, probably the only reason why it won't be catastrophic for any one particular country.
Exactly.
But yeah, isn't
that at some point the wheels will really come off?
But that's the thing, that if let's say you're a rich person, you've got a couple of million in the bank or more, whatever it is, then why?
I thought you had a couple of million in the bank, Zach.
Well, I was pretending that it wasn't me. But the point is that if you are this hypothetical rich person, totally distant and not connected to me, why, you could just sit at home and do nothing. Wouldn't that in a way would have the biggest consequence for the economic system, in the sense that if the entrepreneurs think, well, actually, this is just a mess. Every time I try and do any business with a country, there's this comes in, that comes in. I can't travel. I can't do anything. I'll just sit at home at the sofa and engage in, podcasts and webinars.
Well, here I am, and engaging in a webinar. Now, let me just say this. I think it's a problem. I think it's a really quite a big problem. It's so chronic that nobody will care or notice. But when you look at how cheap a lot of the UK companies are and how free money is, you notice that no one's taking them over. And that's because I don't think they can get on an aeroplane. And also, yes. I think that a lot of the advisors are, painting their pergola or whatever you do in the winter, chopping logs. And, the amount of people I speak to when I'm doing business that appear to be walking down the street, or whatever. So, it doesn't seem to be keeping people in, but it's keeping people from traveling.
So you're ruining the entrepreneur. The people who bit of get up and go are not able to get up and go. So that sort of, which is obviously the main driver of the economy. On the other side,
got up and went. I mean, they are quite liking this. Honestly, I'm really working from home thing. And I know banks make their employees jiggle their mouse every 15 minutes. But I think people have gone into some sort of pseudo retirement, which is strange.
Clem, what is going to be the impact of raising interest rate, which is what everybody's talking after yesterday?
I think, as always, people fixate on a number. And if you fixate on one of the variables, that becomes pointless. because the game always shifts. Yeah. If I want to borrow money, I will borrow it at 20%. We all do. It's called credit cards. If I need to borrow money, I'll borrow it at 10%. I'll borrow it at 12%. I'll borrow it whatever. If I've got a gambling problem, I'll borrow it at 90%. It's not the interest rate that's so important, but the availability of the credit.
Yeah.
Now, if they put interest rates up for corporations from 3 to 3.5 or to 5, no problem. Yeah. But if you can't get the money at 5 or 6 or 7 or 1 even, then you go out of business. Thank you, my beautiful assistant. This is what I need. Coffee. So anyway, so it's the availability of money, not necessarily the interest rate that's important. I mean, I remember Tesco's putting out a bond at 7% 15 years ago. I mean, you know, they were happy to borrow money at high rates because they could pay them back. Yeah. And, you know, with today's modern accounting, if you took out the balance sheet, all the intangibles all these corporations have, they'd be insolvent. And then you look at all the businesses on the FTSE that are actually insolvent because they're negative equity, and you go, well, how can they even exist? Well, it's because they can borrow money. And, you know, if you ask them to borrow an extra 1%, they'd say, sure. And if it's going to be extra 2% now, they say, sure. Oh, it's got to be 6.5% now, they say, sure. As long as I can get it, I'm going to be here tomorrow.
But
so it's the availability that's the key, and the new QE banking system, etc. The new monetary policy out there enables there to be new money, so everybody who wants it can have it.
Who are those companies they are going to be able to pay such interest rates? So
they can all pay such interest rates because all you have to do is keep rolling it. If you're paying 7% and you need 50 million, but you can borrow 100 million, you can get half a century down the line before you run out of money. And then, of course, you know, oh, we got this liquidity and we need more liquidity. You mean cash? Let's call it liquidity, shall we? Because it doesn't sound like we need cash. Okay, then you need some more liquidity, do? Oh, yes. Look at our balance sheet. We're totally solvent. Don't look at the intangible assets, which are half our balance sheet. And if you take them out, we're probably insolvent because those intangible assets are meaningful. You know, I can buy dinner with those intangible. Oh, no, I can't. In fact, what can I do with those intangibles? I can't do anything with them. They're worthless. Oh, well, don't look at that. We're in a modern economy now. So give me more cash and we can stay in business. Oh, thank you very much. And that's how most of these big companies have been operating for 20 years. The point is, if you say, well, you know, interest rates are 2%, but there's no money to be had, they'd all go bust.
Yeah. Because
they wouldn't be able to roll their bonds. There's not a business in the FTSE 100 world, there's probably 5 actually, that if they couldn't roll their debt, would go bust. Yeah, and their debt never goes down. Have you noticed? It never goes down. And their intangible assets then never go down. Yeah, so you wonder if they're really making a profit at all. And the ones that do, that pay dividends and throw off cash, yeah, everybody looks down their nose at them. So we're in a world where of electronic money, where the availability of it is the key, not the rate of interest. Yeah. So you will see the interest rates will go up, but you'll still be able to get as much money as you want. And you know, there wasn't a business on the FTSE 100 that wasn't paying 5 or 6 or 7%, you know, back between 2000 and 2010.
Yeah. So talking about some of actually our favorite subject, which is gold, Zach.
It's your favorite subject, it's not mine.
Silver.
I hate gold.
Defunct asset.
All right, let's just touch briefly about some stocks. So
let me touch gold.
No, talk about gold. Talk about gold. I'd like to hear about
gold.
Yeah.
Right. And
Zach is Mr. Market right now, in as much as he has his finger on that pulse, which is gold. Who needs it? Oh, don't enter its web of sin. Don't go in. No, gold. Oh, bad. Oh, rubbish. But actually, it's performed really, really well over the last 20 years, as anybody that bought it at 250 will tell you. But it's definitely on the back foot right now. However, now that Jay Powell's come out and said, yeah, we're going to put up interest rates, but, yeah, we're going to take it faster. Yeah, it's all under control. All of a sudden, it's going up. So I think people are more worried that there will be proper high interest rates and there will be proper taper, and that the hawks will come in and go, no, none of this 120 debt to GDP, and that's very, very bad. That's awful. We'll have a massive recession and depression. To get that debt out of the system, we're going to have austerity. He's come out and basically now people are sure there's going to be no austerity, and therefore there will be enough liquidity. And even if interest rates go to 5%, so what if you can borrow it? Everybody's happy at 5% interest rates as long as you can get infinite money. So now we're still facing inflation. If inflation goes too high, the wheels come off and the markets crash. If inflation just runs hot, 5, 6, 7% for the next 5 years, then the market's going to run, gold's going to run, everybody's going to have a party, there'll be an economic boom, GDP will catch up, things will rebalance. They've got to run the inflation at a sustainable level, which is probably about 5 or 6% on the dial these days, which would have been 10, 11% on the dial in the old days. And gold, therefore, has got to pick me up because they're saying, we are in control, we do know what we're doing. We are going to get some inflation, but not too much. And we are going to make sure there's going to be enough money around. And we're not going to go out and be all old-fashioned about it and say, you can't have this sort of debt.
But what's going to happen? Sorry, Clem, what's going to happen if, say, we get 5% interest rates again? If we got that, which obviously we should be getting that because, let's say that's where inflation is. And you get to the situation where this hypothetical person who's nothing like me and is not interested in the financial markets at all, puts his £2 million back into the bank on deposit and gets whatever 5% a year is on 2 million, which is I think quite a nice little income. Then you literally have no reason to get out of bed, do you?
Well, I think a lot of people haven't got a reason to get out of bed right now. I think that's half the trouble. I mean, in the old days, Christmas used to start on about the 6th of December.
Yeah.
It started in November this year.
No, right? I saw it started in September. I put a photo on Instagram. It was like advertising for the Christmas party, September the 20th.
Or you need to get a turkey. Exactly.
I was there in my swimsuit, and they were talking about Christmas. And I was like, "What's that?"
Well, if you look at the so-called Great Resignation, there's a lot of people who are basically just saying, "Oh, I'm retiring now." So I think that's a big worry for productivity in GDP.
Well, isn't it good that the old codgers get out of the way and then the young people like Stefania come into the picture? She can interview two young people.
I hope so. That would be good. I mean, I'm quite happy to get out of the way. I think young people are great. I mean, it's like when I was a young person, lots of young people were idiots, and there were a few bright sparks out there. I started as an entrepreneur when I was 18. Yeah, and all the people that were starting as entrepreneurs in those days were like 30, and they all hated me.
So you've done a half a century, haven't you? That's fantastic.
Yeah, a half a century, or near as that. No, not quite. No, not quite. 100 years. But no, actually, no. I started when I was 18, so I've only been doing it for 20. But the young people, there's the bright sparks, and then there's the dead wood, and then there's the lucky ones. I mean, there's three sorts, right? There's the ones that are lucky, and there are the ones that are bright, and the ones that are given it. Yeah.
That is true. I'm all of them. I was actually all of them, so it's fantastic for me. I just didn't. I mean, literally, I didn't have to lift a finger. It's been such a great ride.
But I think one of the things of the new generation is they don't have the experience, and even though you can be as bright as you want, but if you don't know the history,
that's totally wrong. That's totally wrong. They're having an absolute wave of the time. All these unicorns, they're all kids. Yeah, and these unicorn kids are all over the world. They're in America, they're in Australia, they're even in Japan, they're in Israel, they're in the UK. I mean,
isn't the thing with if you're young today, say you're 20, 25 today, right? You've got so many different ways of making money, which they just weren't there before. There was no new economy. In the 1980s, I mean, literally in the 1980s, what were you going to do? Work in a factory, maybe a lawyer, doctor, accountant. That was about it. I mean, literally, and then obviously the stock market was there, but you had to be friends with, somebody posh in order to get there. So that was out too. But these days, I mean, literally everything from, a sandwich maker to a bike company to electronics. I mean, there's everything. There's so many things there now. It's almost impossible not to be in an area which is entrepreneurial. So isn't there much more opportunity now? Plus, you don't need the capital. Right. You don't need the capital now. Before, you needed to get a decent amount of money. Now it's just a website and an idea, and that's it.
I think that's totally right. And that's one of the good good news pieces. Is that there are so many younger people. I call them kids, but that's not right to call them kids. But young people, doing some really, really way out exciting stuff. I mean, just have to look at crypto to see that. And I think that the lockdown environment has changed the very basis of the way that things have been done, and there's no going back. I mean, I wouldn't want to own a tower block right now if I was in the office business. I mean, are they ever going to get them back in there?
Probably not.
And what about bus drivers? What about train drivers? All that stuff. I mean, is the underground, all that stuff has the whole balance of those businesses surely changed?
But Clem, even nightclub, I mean, I really think that very soon everybody is really gonna hang out online, because you can't go to these places unless you are vaccinated. I just got an email from like a London member club say you can't come here unless you've got 2 vaccines, right? I'm vaccinated, but why you need to show up your passport? And that everything's
been doing that for the last 10 years anyway. So yeah, I mean, exactly. most meeting is online in any event, and but there's nothing. The dating game does need a little bit of people meeting people, but I don't know. I mean, I'm past it. I think the Reform Club is a nightclub, so it's I don't know.
Well, in a way, I agree with you, but I still think that the generation of our parents, our grandparents is always very useful for any young entrepreneur to just be less impulsive, because when you are 20 and 30, you would just do everything without thinking thoroughly through. Not all of them do, or not most of them do. You just have too much, you follow your guts all the time and say, right, let's do it. But sometimes it's good to just stop and analyze. And this is something you learn when you get older. So we shouldn't discard the older generation.
We shouldn't discard the older generation. I'm useful.
It's the oracle.
But ultimately, I think that getting on with it, just flaming doing it, is much, much more important.
Yeah.
than all that planning and talking and all that sort of stuff. Yeah. Actions speak much louder than words. And in business, you never can tell what's going to happen. You never can tell who's going to be your friend, and you never can tell what your product's really going to be. And you just got to get stuck in there. And when you get stuck in there, if you're energetic and you've got a good project and you've got the right idea, then you'll do well. And if it was a wrong idea, you do another one, and you do another one, and then one of them catches, and away you go. And that's what they're doing, and that's the way to go. And that for entrepreneurs in various places in the world, it's a very interesting time. But I think with the COVID will never go away thing that I think a lot of us are probably imagining is going to be the case, then the work from home environment, the virtual spaces, it will morph, and the young people will get a break to get in there, because it's like the people that needed a secretary. Yeah, your days are numbered if you can't adapt to this situation. And what I've always thought is, if you don't have high value and you're working from home, the walls will come in on you, because the people in headquarters or the people that do the bin counting will go, well, we've done all the numbers and we've got 25% more people than we need, because the people that actually work hard are doing all the work and these people are doing nothing. So we can now go snip, 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 snip. And I think you'll see that. So companies will get smaller and tighter, And you know, you're already hearing people saying, oh, I've got no work-life balance now because I'm working all the time. Yeah, right, of course you are. But you know, that dynamic, if you like your work, if you love your work, why wouldn't you work 24/7, 365?
Yeah.
I mean, I love
Who loves their work? Who loves their work?
I do. I love it. I absolutely love it. I work 365. You know,
are you nuts? Well, you obviously are nuts. So, no, I mean,
love it. I love it. It's like.
How can you prefer working to doing absolutely nothing and watching TV?
No, I can't.
I think you'd be surprised. Once you never judge people by your own standards.
I don't have any standards. No, I understand that. I've actually got to do an interview now, so I wanted to just talk about a couple of things.
Okay, go on.
A couple of my favorite tiddlers. First is, I think, quantum blockchain, which is.
Oh, wait. So let me just share the charts. So, right, that's something that I want to talk to Clem afterwards. So what is quantum blockchain?
QBT.
Yeah.
Quantum computing. That's something I would get out of bed for. I like the idea a lot, and look at that chart. I mean, that's that's the.
It will be. It will be.
That is nice. That is nice, isn't it? Actually, nicer than I thought it was going to look. So that is.
What's happening in 2024?
It's a big V sign. It's fantastic. And so
double top, head and shoulders. Come on.
No, that looks beautiful. I call it a V-shaped bull flag, actually. So that's one that I think that's very nice. And quantum computing. I think they're applying for a patent and all that sort of stuff. So, you know, we like that sort of thing, you know, backing something which is a new technology, don't we, Clem? Sort of.
We love anything blockchain, and if they did manage to get their photons between two slits in the right way, then obviously they would go to the moon. But
yeah, and then the other point was, I think I mentioned a company called Gunsend a few weeks ago, which had done a lot of stuff this year. You know, made money, GUN, and it done a lot and everything else. And the market, for some reason, it doesn't like GUN, as in shoot me.
Yeah, sorry.
Basically, the market has the stock. This was probably just as well, actually.
Just
1 year. Yeah. And so basically, the market just is not impressed at all. If you do a year, that might be better, but it's you know, you get the picture. And and then, so yesterday, I interviewed another company.
Just drag that, Steffi. Just drag it. Yeah. Go down to it says April the 20th. April the 20th. Down. That's down. No, not down the page. See where it says April the 20th? There. Down.
It's like the golden shot, isn't it?
Down a bit more. Down, Steffi. Down. There. Yeah. Right. Now drag it the other way. Other way. There you go.
Yeah, that sort of thing. Anyway, so it's basically even lower than it was last year. And if you look up the tech and everything, you look up the fundamentals, you'll see they did all this stuff. There was a rally because it was the Q1 rally this year on a lot of things. And we're still actually in that hangover from the Q1 rally, which is a little bit unfair, I think, to companies. I interviewed another investment company called Pires, P-I-R-I.
Yeah, today they are going through the roof. I just saw them.
And obviously I can't take any credit for that because it was the guy who was speaking who take the credit. But the shares at sort of 4.5p, 5p are at their NAV. And again, this is another stock which they've done everything right. They've turned $100,000 into 2 million, et cetera, but the market doesn't give a monkey. So that's the sort of market that we're in at the moment. But I think it is a lesson that if you are a tech investment company, you've got to come up with something really, really good for people, especially in the UK, to get impressed.
The city hates tech.
Yeah, it just hates tech. And so I think on that basis, I think that it's not the remit of my tech company to be necessarily buying up cheap UK tech, but I think there is an opportunity there for probably a US company to buy UK tech and then sell it on in the US.
When the takeovers start, and they must start at some point, when people find a way to take over British companies from America without getting on a plane or whatever it takes, or being able to get on a plane or whatever, be beamed down by Elon Musk to London, when that takeover run starts, and it must start because it's just money to be had, billions of it, then that will change the dynamic of FTSE on all these stocks. Because anything cheap will get snapped up.
All right. Well, that's it. That's it for me. Thank you very much, folks. I'm returning to the sofa, my sofa of destiny, and hopefully we'll speak to you both next week. Yes. Thank you.
See you then.
Bye.
See you then. Ciao, man.
Bye.
Bye.
Clem, so let's well, that was interesting to see this. Let's go back to a company that we talked about a while ago. Now I can't find it anymore. What's the ticker of OSH?
HOC, was that the one?
H?
H for, yeah, HO.
OC, yeah, exactly.
Yeah, there you go.
Because I remember that you mentioned, I mean, we talk about it when there's something happened in Peru.
Well, I made a nice little trade on them when they fell off the face of the earth. They're having a punch up with their local government. It's Peru, I believe, off the top of my head. And Peru have got a radical. I mean, this is trouble with all gold mines, pretty much. All the ones that are affordable, they're all in crazy countries. Now, I'm never sure whether that's, because first world countries like Britain and Germany and France, they won't let you build a gold mine, even if you found gold. They would say, no, we don't want any of these huge dam full of cyanide gases, and we don't want you making piles of slag all over the place. We don't want any of that. Because when you think about, all that ancient gold that you see that, in ancient coins, that all came from Europe. And today there's hardly anything in the way of gold mining in Europe. I mean, the French had massive quantities of alluvial gold. And all the old Gauls that fought the Romans and went into battle naked with big gold bars around their neck, all that came out of Europe. But you don't see any mining there because, basically the environmental concerns of the Europeans mean you can't do this mining. So you end up with gold mines in the middle of Antarctica. I mean, well, not Antarctica, but, out in Siberia, in deepest Africa, in South America, in the Amazon jungle, that sort of stuff, because they are actually allowed to have a gold mine. But then you're working in countries which are volatile. They can go into revolution, they can go into war, they can get radical governments who then say, give us your mine. The history of these kind of developing economies that used to be called the third world once upon a time, but that would be a nice thing to say these days. But the developing countries politically are not very stable. Or have instability issues. And now and again, you've got a gold mine and the government comes out and says, give me a gold mine. In this case, they've gone out and made some pronouncements that they're not going to renew mining licenses to a huge swathe of Peruvian mines. And all those mines kind of went, and their share price dumped. And then they came out the next day and said, we didn't mean it like that. Oh, no.
Exactly, and then it goes through the roof.
But, it's not a... people who invest in companies like this want a premium for a company that might suddenly have a bad day because the government decides that they don't like them anymore. This is what happened to Hochschild. But again, the overall thing you have to do is you can't go around putting big percentages of your portfolio into anything. And even if it was British Telecom, you can't do it. You have to say, well, I'm going to make a diversified portfolio. I'm going to have gold. Well, what percentage of my portfolio am I going to have gold? 10%, 20%. Then you say, right, okay, 20%. How many gold mines can I buy that I like? So you could go through all the gold mines that you like, and then break that chunk of money down into 5 or 6 or 10 or as many as you like gold mines. And then you've got a diversified portfolio of gold mines within a diversified portfolio of shares. And that's how you do it. So when Hochschild collapses, like it did, I think it's down 57%, something like that. I didn't go, I'm in shock. I'm going to cry now. I'm going to go away. Ruined forever. I went, bloom it. That's unfortunate. And I bought a bunch, and then it bounced, and I sold them again. So I made a little trade because I didn't really care, because I just taken a 0.25% hit to my portfolio, which is a fairly large chunk of money. But when you see it within the big picture, you're not crying and you're not panicking and you're not wailing, because you're diversified. And actually, I think probably on the day, the rest of my portfolio cancelled out that 50% of one of the members of my portfolio. So that gives you an idea of the benefits. Of course, if you wait long enough, you get 2 disasters in a day. Yeah, but also you'll get 2 wonderful outcomes in the day as well at some point. So, diversified portfolio is always the way to go. It's only in very, very wild times, like you think the market's going to crash, that you sell out your portfolio. And then when you re-entered, you would buy back a portfolio. You should never put a huge amount of your savings in any one thing. And if you get to be at a certain scale, that goes for banks and that goes for brokers. And it really is quite a difficult challenge if you have a large capital sum to actually be diversified. And a lot of what you see in the market today is about companies and large organizations and super rich actually trying to diversify and get into a situation where they are protected to some extent from bad luck.
Here I have got a question. Do you think it will be something interesting to see some of the listed company to start putting some crypto on the balance sheet? Do you think it's something possible? It will be quite interesting to see. It's going to make any difference. It will send a signal.
If you're a public company in the UK and you start doing that, they will hang you out the window by your toes. Yeah, crypto is not welcome in the UK.
All right, so it's not something that we are going to see. Anyway, we kind of
you might see some of that, and it will change at some point. But it's like a cause of celebration that one company actually got regulated by the FCA. If you're a car dealer, you need to get regulated by the FCA. I don't see there's a huge waiting list for car dealers to get regulated by the FCA. But the regulators and regulation in Great Britain, there's hundreds of thousands of them. They regulate everything. They probably regulate toothpaste. But crypto companies, oh no, please wait. Okay. Yeah, because it's good news and bad news. It's very bad news for the UK. But for individuals, it shows you in very stark terms just how powerful crypto is, just how terrified government is. Well, government only gets terrified by things that are very real. Yeah, America just put sanctions on some Chinese drug makers who are making precursors to lots of opiates and all that stuff. That's killing 50 to 100,000 Americans every year for the last 10 years. It took them 10 years to do anything about that. 10 whole years to save what amounts to 500,000 or more people's lives. Yeah, that's how fast regulators move when they don't really care. Yeah. When they really care, because it's something that affects them directly and they're frightened of, they get busy quick, right? So you're seeing with crypto, now it's on their radar. They're very, very scared of it because it affects them directly. It's that big a thing. Well, you cannot put technology back in the box. You can't uninvent Bitcoin. You can't uninvent DeFi. You can't uninvent Ethereum. You can't ban it. It will have to be embraced, and it will be embraced. And what you're therefore seeing is just the tip of the iceberg for the whole crypto movement. Now, one thing is for sure, crypto crashes and moons and crashes and moons. It's incredibly volatile. It's a very, very full area. And in 10 years' time, after people on that list you're showing won't be there. However, crypto will be, and crypto will be massive. So I don't know if Watchers have ever done this, and they go, well, if back in 1992 I'd put £1,000 in that, I'd be laughing there. It's gone up 1,000 times. I would have 1 million. Yeah. And all those companies that I saw come by that I didn't buy a lot of, I liked Amazon. Why didn't I buy it when they were $7? I liked Facebook. Why didn't I buy that? I think I use Google every day. Why didn't I buy that? All those things, when you're Captain Hindsight, you can imagine how well you could have done if only you'd known. Well, you can turn that telescope around and apply what you didn't do right or what you missed out in tech, for example, to crypto. Now, if this is 2001 or 1999 for tech, what should I be doing? Well, I should be avoiding all those crazy companies that had nothing that were highly valuable. And I should be looking out for who's going to be the Amazon, who's going to be the Google, who's going to be the winners of this race. I mean, you could have done the same with all the chip people back in the 90s, etc., etc. So you can apply the lessons, the foresight that you, the hindsight that you have in tech and in equities. You can take those hindsight rules and apply them to crypto now, and there will actually be foresight. So you've got to find out who, in your mind, are definitely long-term winners, because they look like long-term winners. They have the attributes of what were long-term winners in tech, and apply that.
I think we mentioned Matic last week, and there are a few others. But just coming back about diversified.
I love Matic. I love Matic, but I did sell out a few days ago. I took a nice profit because I think that we're in a bear market on crypto, and I think we're going to see it come down. Now, I've been very wrong and continually wrong and predictably wrong about crypto ever since it went up the first vertical. And I took my profits, and I've been poking around ever since, taking a few trades, because I thought 40,000 was the top. Definitely in the 60,000s was the top. When it crashed that time, I thought it was going to go down under 20. Afghanistan, Chinese social clampdown turned the market around, and it's went back up to that high again, double top, head and shoulders, all that stuff that Zach would tell you. And now we're on another bear. The question is, it feels to me that Bitcoin and Ethereum have reached levels that are sustainable, or they are comfortable at. So it's not like commodities that go from $300 a ton to $6,000 a ton and then come back down again and never go back up. It's like these levels we've seen sustained high levels in crypto now for the best part of a year, and so I think that's quite bullish. But I can put my bullish hat on and go, well, it's quite bullish. It's sustained at these levels, but actually underneath that bullish exterior, there's a bear, because I think we will go down to at least the low of the last crash this year, down into the
30,000.
Yeah, in and around there, and depending on what happens when that occurs, we'll define whether it's going to go down further. But the long-term picture is that it will be 100,000 within 3 to 4 years.
Yeah,
I'm absolutely sure of that. And I just don't want to buy at 60 and then have to wait 4 years to sell out at 100. I much prefer to try to pick a bottom on this one, because I'm out of investment mode, have been since, I was buying for years before the last spike. And then I got out of investment mode, and I'm totally in trading mode. And not until it pulls back to the point where everyone's saying, oh, Bitcoin is rubbish. Oh, no, crypto is rubbish. Oh, that was just a fad. That was just a phase. That was just a fashion. No, it's rubbish. Not until I hear that do I really want to commit. And then as a contrarian, I will commit when everybody says what a load of rubbish it is. And it's gone in the last 6 weeks from, it's going to be 100,000 in a minute. Yeah, by Christmas. Yeah. To now it's gone mighty quiet. And it's gone quite, pessimistic, and everybody's going, well, it's not going to go down, is it? It's not going to go down, is it?
Well,
probably bullish.
One of the interesting things is to see actually on the Chicago Mercantile Exchange that the future of Bitcoin was trading lower than the spot price, and that is a signal, is a clear signal.
Yeah, I don't follow those kind of markets, because I find that's where the speculators.
Okay, the manipulation, right?
And no, none of the manipulators, speculators. It doesn't give me a signal, or I don't get a signal from it. All I get is interested in trading noise.
Yeah.
And noise is what costs you your capital, because if you trade it, you're right half the time, wrong half the time, and you're always paying for trading. So your trading costs over time just eat away your capital. So it's like options. If you want to lose money fast, start trading options, because you are the fool at the table there, and they'll take you, and they do. And that's where a lot of all this money in the equity markets that the youngsters got on this post-COVID rally it's all gone on their trading of options, and they've lost it all in options. And speculating is costly. Trading extremely difficult. You need a lot of practice at it, and even then, it can be costly. Investing, investors fly in private jets. Traders end up wearing orange jumpsuits. So it's investors that make the money, but you've got to have criteria. You've got to really, really, really be in a state of, you absolutely know this is a good investment before you invest. Anything weaker than I really, 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 really know, you're going to have a hard time. So at the moment, I think Bitcoin is betwixt and between. It's kind of bullish, it's kind of bearish. I'm a bear. I'm on the bear side of this. Every time I draw patterns for the bull and the bear, it goes up the bull pattern. But I think we're at a very interesting point in all the markets, equities as well, bonds as well. Yeah. And if you think about Bitcoin, if I can just ramble on a bit more, Bitcoin, the market seems to think Bitcoin's an inflation hedge. And that is so crazy that you've got to be concerned about the logic that's driving the market. Because if they wake up from that logic, or the logic changes to something else, there'll be a big move.
And the crazy thing is that I was actually listening the CoinDesk podcast this morning, everything about crypto, and the title was "Bitcoin lost its inflation edge," and I said, "Why? That's something that Clem is going to be."
I mean, it's not an inflation hedge if it can move in a month or so 30%. I mean, when was it? November, it was 65,000, and now it's 50 or 48 or whatever it is, 50,000. So that's 15 on 65. Well, that's about 23%. 23%. That's no inflation hedge if it can move against you 23%. Yeah, and volatile things are not necessarily good hedges against inflation. Yeah, if it is volatile, then and inflation isn't. Inflation just goes chew on house. Now that's a hedge against inflation, because it goes up as inflation goes chew. But if you've got it going chew, and you've got your asset doing that, that's not a hedge. That's a triffid. Sorry, old joke for anybody who knows what a triffid is. But
so Clem, let's maybe just to recap. So basically, what would be your advice, considering what we said, that we might be a risk off, we don't know where we are going, there might be a bear market coming, is a bit of uncertain. Is better to sit in cash, or would you take a different approach where you keep some cash, staying gold?
By inflation, so you kind of have to not. You can just go, oh, I don't care. I'll lose a third of my value and I'll just sit here, because it's better than getting in the way of a crash and getting run over. Well, I don't think that's right. And to be honest with you, that's where I'm sat. I hate it, because I don't really want to catch, a clip round the ear from the market going down 30%. I don't really want to be loaded up in crypto Bitcoin if it's going to halve. So where do you put it? And but this is the flip side of the coin from what the bankers, not investment bankers, the central bankers and government is trying to do. They're trying to hem you in so that you have to work hard, pay your taxes, and pay the price through inflation. Yeah, because that is their only way out, because they bailed out their economies, the global economy, from absolute meltdown. I mean, they could have said, we're not going to lock up. Goodbye, old people. We loved you. Oh, we'll get on with the economy. Oh, look, we turned a few football pitches into hospitals. Oh, everybody got it. Herd immunity. We lost millions of people. Oh, well, how medieval is that? But we still have our economy. They said, we're going to pay the price, take a big haircut in wealth, and we're going to stop this thing. Well, they've done a good job at that. And I think everybody is prepared to take the haircut. Most people are prepared to lose 10% of their income to save their granny. I mean, who wouldn't lose 10% of their income to save their granny? It's a trade everyone would make. However, there's a moment that the credit card machine comes around and says, you know, £1 saved, that'll be 10% of your net worth. Well, that's got to be paid for. And the only way it can be paid for is through the flat tax of inflation. Because that jump from whatever it was, 87% GDP to debt, to whatever it is now in reality, 110% or something. That jump, it has to be brought back down again, or brought back down to an economically growth sustainable level. And that's the cost to our society of the COVID interactions that all countries have done. And I think everybody agrees with. But there's still a price there. And that price has to be paid. It can be paid with higher taxation. Well, that's not going to be great. The economy will collapse, right? Again, so we're trying not to have that. So the best way is just to get the little inflation gerbil out to go chomp, 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 chomp. And that is the equivalent of you being charged money, right? So that is how it gets paid out. And that is what we've got. And it's going to carry on because the bill has to be paid. So you have, if there's an escape hatch, everyone was going to say, yeah, I was all for it at the time. Bye. So they have to bolt that escape hatch down so everybody gets hit, or a large enough proportion of people get hit, so that they are, so the bill gets paid. So there's a reason why it's hard to know where to go, because the piper is here to be paid. And if there's a way of getting out of it, you know, the old first out of the cab and last into the pub trick. If they don't shut that down, then it's going to work out badly, because they'll have to have an unfair shift onto people who aren't able to. Well, if no one can escape, that's fine. If lots of people can escape, not so far. So that leaves us with, where do we hide from inflation? Well, you can make sure your money's not in your country. Okay, and that's totally legal, right? It's not legal in China. It's not legal in India, but in the UK it is. And I don't mean necessarily moving it physically, but you could put it in Swiss franc, for example, or you could diversify your currency, or you could put it into a currency which you don't think is going to get inflation, for example, the Swiss franc. Yeah, so that's one way. You can put it into assets which you think also will move with, that are not over expensive already, like real estate, and will move with inflation. But obviously you can see that there's what looks like a protective coma in the precious metals at the moment, because they're so plumbed into the financial circuit. It's quite easy for governments to kind of short circuit that, and it's really difficult to own those assets. Yeah, there's real estate, which has pros and cons. The major pro is it's a long game. You buy real estate, it jiggles about. You can get the income, pay the tax. You can work. You have to put work into it to keep it not being too much of a liability, and then it might, over the long term, it turns into a massive asset. Yeah. Downside is they know where you live, and they can come on and say, yeah, we're going to jack the rates up. We're going to put rates are going to be like a wealth tax. It's going to be 2% of the property value per year, like it can be in America. All sorts of things. Oh, and we're going to rent control it because the poor people can't afford to rent it from you anymore. Probably, there's all sorts of regulatory and work risks with that. But it's tried, it's tested. There's more billionaires that have made themselves billionaires from property than any other asset. And obviously everybody loves real estate, apart from me and Zach. But the world loves real estate, and you can buy it all over the place. You can go to Dubai, buy a flat, and that gives you dollar exposure. So there's a little bit of a hedge in property. You can buy it in France and never visit it anymore because of Brexit. You can do that if you've got a big capital lump sum. If you can lever it up abroad, you can, as I said, you can put it in Forex. Alternative assets, very difficult, because actually there's normally huge secret transaction costs. So buy a Monet, have to pay 20%.
Exactly. But also you need to know where. I mean, you can buy as many paintings you want, but then where you put them, you can't just.
Well, I mean, yeah, but you put them in, if you got the money, you put them in a warehouse. If you're not a rich person, you buy prints and you put them in an envelope and you put them in a drawer.
I mean, how horrible is that? Would I buy a nice painting to just keep it covered? I mean, I don't know. I would like to see.
It's a share certificate.
I know, but yeah, I just think art, you need to see it. Yeah.
Okay. Now, most people, in fact, buy art for investment, and it's a tricky business. But let's just say you get a catalogue of prints that have been
Mr. Brainwash.
forever, but you're paying the 20 to 25% premium to buy them.
Yeah.
Then when you come to sell them, you're going to take a 20 to 25% haircut to sell it. So you have to have it double in value for you to even stand still. So that's the trouble with these so-called alternative investments.
Gotcha.
And, you know, there's lots of people want to say there's some whiskey, you know, oh, we got some whiskey, it's in a warehouse, honest, and it'll be great in 10 years. There's all that stuff. That never pans out in my book. So you've got property, you've got bonds. Well, interest rates going up, not going to be that friendly to bonds. So not bonds. You've got equities. They're still pretty good, I think, particularly in the UK, because the price, the value, the UK is such a laggard market in comparison with, say, the DAX. Yeah, if you run them side by side, you see that massive outperform or underperform from the FTSE and American market. So it's almost like it's pre-crash. So you've got a little bit of foundation up here. And there's lots of income stocks out there, which, you know, people say, oh, well, interest rates are going to go up now. This thing's paying 5%. What are you talking about? Yeah, but the market hates them. So there's a bit of a, you know, a confusion. So it's very, very difficult to say, well, I wish I could say to you, what you need to do is you need to buy stamps or whatever. Or what you need to do is you need to buy sacks of silver coins and stick them in your basement. I mean, I actually thought of doing that, but then I thought I'd end up like Scrooge McDuck with a swimming pool full of coins. And, you know, it's like impractical. And then they're not liquid. You have to get sacks of them and go to the coin. I've got a sack of silver.
Yeah, I know.
You know, so it is very, 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 and the easiest solution, the most liquid solution is to stock pick. And the best way to stock pick is to buy a book on a certain type of investing. I would say value investing.
Yeah.
Not a book. And then build a portfolio of cheap stocks that pay good dividends and that are, you know, big companies with long-term solid businesses that are paying good dividends. And in fact, I've got a list on my machine because I just wrote an article.
Okay, Clem,
and I'll read it out, and then once I've read it out, we can call it a day. But
okay, go on.
This is an example, and I do an income blog, which is really difficult to do because income in this market really, really tough. But anyway, so very, very simple. Big company, UK big company, got to be worth more than $1 billion. Okay, big company worth more than $1 billion that isn't in a mess like British Airways or whatever they're called, IAG. You don't want any of that. Big companies that you've heard of. Yeah, so you want them to have more than a 3% dividend because you don't want to get pennies. You want to get a nice punchy dividend. And you want to have a PE. That means you could buy the company for N years of profits, give or take. You want a PE less than 12.
Okay.
So you know, if you manage somehow to own that company or borrow a chunk of money, you could pay off that loan in 12 years. Yeah. So under 12 is cheap in the modern era. It's 14, 15 is the average. 20 is not uncommon. 30, 40 if you're looking at a marvelous darling of the stock market. But 12 is cheap. You could knock that down to under 10.
Okay.
If you wanted to. And so PE under 12, dividend yield over 3, and market cap over $1 billion. And you can look for whether directors are buying. You can look to make sure they've got great cash flow. You can look to make sure they've got big sales, all that stuff if you wanted to. But you'll know these names. Now, right at the top is a sort of this list, highest dividend payer. They're the ones you need to be worried about because why is that dividend so high? Did something go badly wrong? So right at the top is a company called Ferrexpro, which is a iron ore company. And, you know, I think they've got their iron ore all over the place. Who knows where it is? But nonetheless, iron ore, mining. But anyway, they've got a PE of 3.6. And they've got a dividend of 17%. Now, that really is spicy. But let me go down this. Plus 500, which is a spread better that most of our viewers may have heard of. You know, everybody went, wow, who are they? Wow, that's crazy. But that's years ago. They keep turning out these profits. They keep turning out these dividends. They got a dividend of 10%. These is trailing dividends, so some of them may be up or down going forward. M&G, one of the biggest fund management companies on planet Earth, have got a PE of 4. I'm looking at this number going, but I have done that a few times already, and it is 9% dividend. Yeah, Imperial Brands, which is tobacco. Yeah, a 5 PE, 8% dividend. Bank Santander, 7 PE, 8% dividend. Rio Tinto, one of the biggest mines miners on Earth, go back 150 years. A Spanish copper mine in the last century, or century before last, I think, originally. They got a 10 PE. They got an 8 dividend yield. Now, of course, commodities. Now that is a inflation hedge. So anybody that's digging commodities out of the ground is automatically a hedge. Stagflation, not so much. But we're not going to get stagflation because they're going to keep it. Yeah. Direct line insurance.
Yeah.
Whatever. I mean, I've always watched this one with amazement. 10 PE, 8% dividend. For years and years and years, there's a little bit of that going on, but a huge dividend forever and ever and ever. I just don't get why nobody likes these companies. It's not as if they had 2 good years and a bad year, and then they had an okay year and they're about to have a good year, and everyone thinks they're going to have a bad year next year.
They are quite stable. Yeah.
Yeah. Jupiter Asset Management. Now, these are meant to be the brightest kids on the block. These fund managers that buy shares and tell people how to run their businesses. They're paying a 8% dividend. They've got 11% PE. Most of these companies aren't loved. Where are we? British American tobacco, more of your money I can smoke. Polymetal miner, precious metals, in the good way, in Russia, and places like that. 7% dividend. Phoenix, that's a reinsurance company. They buy up pensions and run them more efficiently, apparently. 7.4% dividend, 7 PE. Aberdeen Asset Management, which just bought Double I for 1 billion, 6%, 6 PE. Legal and General, one of the stalwarts of the British city, just like M&G and Jupiter Asset. Nobody loves them. 10 PE, 6% dividend. Ashmore Group, which I know 2 things about, nothing and very little. 5 PE, 8 PE and 5% dividend. IG Group, famous spread letters, being top of the tree in that forever, ever since I was a little boy. They got a 5% dividend. They got 7 PE. Aviva, again, bastion of British industry. The city, a bastion there. 5% dividend, 5% PE. SSE, electricity.
Yeah.
If we haven't got enough of that, yeah. And they're all windmills and all that nice, allowable stuff. No coal going on there. 5% dividends, 7 PE. Tate and Lyle, which is a sweet deal. Pardon my joke. Sugar, 4 3/4 dividend. Now you've seen the dividends going down. It's top chart. I should have done it backwards, shouldn't I? With some music. Mm-hmm. Cullet Pre-Bon ICAP. I don't understand. This company's just been crushed. They bought a stock exchange called Liquidity. And their share price was going down. But anyway, so they've got a 4% dividend, or had one, maybe worth checking. They're still going to give one. 8 PE. Barratt Development. Really? Homes? Property? Nobody wants that? 4% dividend, 11% PE, and Tesco's. 4 PE, 8% dividend. So, if you wrote them all down, if you send me 20 quid, I'll send you a spreadsheet. If you printed that spreadsheet out and took a dart and bought one this month, and then you took the dart and you picked another one, you did that every month for 9 or 2 years, I think you do pretty well. And you get a nice dividend. I mean, the dividend, median dividend is 7.
Exactly. Yeah. I'm quite amazed how many insurer company that actually you mentioned. Interesting. I don't think.
Why?
Because no, it's just because most of the people, most of the investors, not everybody actually find value in insurance, or actually is looking at a sector like insurance. You might look, I mean, for instance, myself, I've never been kind of attracted by insurance company. It's just, but actually they, you know, they do quite a valuable job, and they've got their upside. So
well, let me the most secret information and rules. That is, the stock market pays you in the coin that you want. If you want money, it'll pay you money. If you want fun, it'll pay you out in fun. If you want excitement, it'll pay you out in excitement. All those things have a cost. Yeah. And if you don't want to be excited, if you don't want any fun, if you don't want to brag about owning a particular company down the golf course, if you don't want any of that, you just want money, then you will get the most money you'll get. If you want to be able to brag about a company down the golf course, you're going to be buying some crazy, you know, la stock. Oh, I've got this wonderful gin company that's going up, you know, and that'll cost you. Yeah, because, you know, supply and demand is about value. And if the value you want, you can't get more value from something than the market will give you. And if you want value, fun, excitement, and prestige, well, you're not actually going to get much of a pound payout. Yeah, because you know, a company can't come along and go, well, you know, we're fun and exciting and we're going to make you feel good, and you know, therefore our share price won't go up. You know, people go, well, I'm going to make money, a little bit of money, but I can have a little bit of fun. I'm going to have, you know, a lot of prestige and status. I'm going to have a great deal of excitement. Well, that's what I'm going to get paid. If you go, I don't want any of that, you have to get paid that much in cash, and therefore you have to go to the stocks that have to pay that in cash, because nobody wants to know about them. Aviva, that's no fun. That's no excitement. And I'm not going to swank about that down the golf course. So they have to pay you that much. But if you're, you know, laser beams in space, all of a sudden they pay you that much of nothing at all. And you get that much excitement, that much fun, and that much status out of it. You know, oh, me and Elon, we invested in this. Yeah. But the market pays you in the coin that you want to be paid in. So, you know, yeah, you probably, you know, much more into story stocks. Everybody is. And lots of people are into gambling stocks. A lot of people are. But, you know, they don't have to pay you in money. They can pay you in press releases.
Exactly.
They can pay you in videos, whatever. So that is something always to bear in mind.
I think is a good,
that you get paid in the market in a way that you want to be paid. And so don't want to be paid in excitement, don't want to be paid in fun, don't want to be paid in status.
Yeah.
I want to be paid in fear.
Yeah. Yeah. I think that was a great a great tip is a great actually point that sometimes people don't actually think about it. So Clem, thank you a lot for today, and we just come back next week before Christmas.